Claudia Ponsati, thank you very much. So with European debt concerns back in the news and the earnings season upon us, what do you do? Joining us now is Sarat Sethi. He's principal and portfolio manager at Douglas C. Lane and Associates. Eugene Profit, that's a good name for a money management guy, CEO of Profit Investment Management. And Keith Springer, president of Springer Financial Advisors. Mr. Sethi, let me begin by asking you, it feels like we've been here before. Last year, there was a soft spot in the economy right about now. Last year, right about May, June, July, we were working through sovereign debt concerns, and it all worked out just fine. Is it going to this time?
I get the feeling exactly what you're saying, that I think right now people are so focused on the rhetoric coming from Washington, looking at what's going on in Greece. But at the end of the day, if you sit back and you say, where are corporations? What are we looking at for global growth? And we are getting very positive signals. Yes, earnings are going to come in, probably not as strong as some of the analysts expect, but they're still pretty strong. Corporations are flush with cash. We just mentioned how many companies are raising dividends. And if you look at global growth, it's there. The question on the short term is the uncertainty, and that's what people are running away from.
I don't know, Eugene, are you seeing positive signs of global growth? Because I'm not sure everybody agrees with what Sarat just said.
Well, Melissa, I think that there certainly are a lot of headwinds, and they're being exaggerated a little bit with the situation in Italy and also here with our debt talks. Although corporations seem to be fine, material costs are going up slightly. We had a very, I think, weak trade deficit number. And I think that basically the contagion fears are going to have major impact on corporate earnings.
Keith, how about the earnings? Do you think the earnings are going to solve things or make things worse?
Now, earnings are going to solve things for sure, Tyler. There's no question about it. Everybody's worried about the rhetoric. We're always worried about the emotional aspect of what's on the front page. Europe will work itself out. The debt limit will work itself out. But at the end of the day, it's always earnings. Earnings is what drives stocks. And 2, 3, 4 weeks from now, I think we're going to look back at a very good earnings season, because even a slowing economy takes a while for it to get into earnings, and I think we're going to have great earnings for a while.
Keith, I agree with you that earnings in the long run are what really motivate investors and explain why a stock does one thing and another stock does another. But in the short term, other issues, extraneous issues, headline risk, sovereign risk can come in and just throw that whole thing out the window.
That's in a very short term. It's a great question, the way you say that, because what happens is people get emotional. They open the newspaper and look the first time in the morning, and then they react quickly. But when earnings are good, and earnings remain good like they have been, they've been positive surprises for several quarters. We're going to probably have another positive surprise. The nice thing about what's happening in the headlines today is it's lowering earnings expectations, and lower expectations are going to allow for more positive surprises. I actually think it's going to be exceptional, and I think stocks are going to really run from here.
But Sarat, a lot of people are saying that yeah, sure, companies are going to beat on earnings, but the guidance isn't going to be great, and that's really what they're listening for. Is that what you're listening for, and how are you investing based on that?
Yes, I think one of the things that you have to watch for is when they talk about guidance, a lot of the orders got pulled in the first quarter because of what happened in Japan, especially if you're talking about the industrial side. And I think that's where you're going to see the earnings expectations come down. The earnings are going to be much stronger going forward, especially in the sectors like the autos, where I think they just didn't have any ordering going on. You couldn't even double order because they didn't have the components and the parts to build everything they needed to.
I want to talk to you, Keith, about technology specifically. We had the first sort of note yesterday out of Novellus. It was not particularly heartening there. A lot of the big technology companies will be reporting over the next week and 10 days. What are you seeing there? What's your forecast?
Technology is going to be good. You got to remember that earnings disappointment announcements come out. Nobody ever comes out and says earnings are going to be better than expected. You only hear about the disappointments up front, and you're not hearing that many. You've heard a couple, which, is expected. You always get a couple, but earnings, especially in technology, are probably going to be better than expected
How
again.
about you, Eugene? What do you say?
I would agree. I think other than in cloud computing, technology expectations have been pretty moderate. And I think if you're looking at Microsoft, Apple, Intel, you're going to be okay going into the end of the year. But I do remember QE2 has ended. That's what really took us out of last year's summer's doldrums. So we're going to need something to help us come out of this summer's doldrums.
Gentlemen, thanks very much. See you soon.
Thank you.
All right.